God forbid if regional banks are repeating what happened in March, then this time the market will go down.
Hi, Dennis. How are you?
Hey, Angie, good to see you. How you doing?
Doing good. I was out of commission for the past couple of weeks, and a lot of things have happened. Let's go down that what's going on in the broader economy and the equities markets. We've had a good sell off. It looks like a little over 5% in the S&P. And then just some news about where interest rates are going. It looks like bonds are spiking up, the yields are spiking up. What do you see going on?
Right. Yeah. Well, you picked the right time to leave. I missed the sell-off. So, yeah, and then the market was doing fine. The earnings were okay. And as soon as August started, then we started going down. First, it was a normal pullback. That sort of we talked about. We expected it. But right now it's starting to look like more than a normal pullback, like you mentioned, more than 5%. The two major issues right now, first, bad news out of China. So the China's growth is kind of disappearing. So it's not a disaster yet. It's not like China is in Great Depression or anything like that. But we're so used to them growing at a high rate that when they start growing a lot less, then it's a concern for the not just their economy, for every country's economies. And what's going on with the commercial real estate is a concern. So one of the companies filed for bankruptcy there and so on. So people are paying attention and they're trying to figure out if there is a contagion. So if there is more dominoes to fall. So that's the number one concern. And the second one, the obvious one, is interest rates. So today we're breaking the last October's 10-year note yield, and that kind of throws everything away. All the bullish narratives were not there yet because with these interest rates, it's going to slow down the economy and the stock market is having problems. We
Yeah,
sold.
let's
Go
work
ahead, go.
that out. Not to interrupt you, but let's work that out for our listeners. Why is negative, or I should say higher interest rates in the bond yields when they're spiking up? Why is that negative for equities?
The first and foremost, the bigger funds like pension funds and other mutual funds and so on, even hedge funds, they start to compare equities to interest to fixed income and say, why would I invest in a volatile asset class, which are equities? And then I can just park money in a 10-year, 5-year, 2-year and get my, anywhere from 4 to 5% or more. And it's
Risk free.
guaranteed, yeah, risk free. And so a lot of money is pulling from equities and going to fixed income. That's number one thing. Second, when interest rates are higher, then forward earnings, especially companies that are traded on NASDAQ and so on, their growth and earnings do not look as good in a high interest rate environment.
Right,
That
because borrowing costs are significantly
forming
higher.
cost.
Yeah.
Exactly.
It's
Exactly.
significantly speaking with NASDAQ because these tech companies are highly, highly dependent on debt. Correct me if
Yeah,
I'm wrong.
exactly. Right. Absolutely. Third reason is the mortgage rates are spiking and they're over 7% now, depending where you are and so on. And that might slow down, definitely will slow down construction and it'll affect a lot of workers, a lot of companies, and therefore there's sort of a chain effect. So everything that, and all other industries that provide materials and so on for the housing industry, that that will affect them.
Okay.
So, uh,
Go ahead. Go ahead.
well, you thought that your mortgage, will be $2,000, and now it's going to be on the new house, $3 or $4,000. You're not
Right.
gonna, or then you're not gonna buy it.
You're right.
Uh,
Or wait till things come down before you to buy.
right, right. So it raises the probability of a slowdown and recession again, and so on. So these two things are concerning.
Yeah, and then it seems like this could potentially lead to a 2.0 banking crisis that we saw earlier. regional banking crisis that we saw earlier this spring, which we thought, not you and I, but the market thought that things were contained. And it looks
Right.
like that could be hit again.
It could be. It could be because with these interest rates and some of the, especially regional banks, they showed us in March that some of them are not as responsible as everybody would like them to be.
Right.
So, and when interest rates are going that high, especially longer term ones, the 10-year, that creates a problem. And from a technical standpoint, I was looking how the S&P and other indexes sold off. It was kind of a steady sell off, no buyers, people are concerned, and that could be contagious. So that could continue. I'm looking at today was supposed to be a bounce, right? Because we got oversold and
Right.
internals and so on. And we're having a hard time doing that because everybody is looking at one thing. They're looking at interest rates. They're looking at the bonds, and bonds keep selling off. So, and it's not necessarily that people are scared and they start selling everything. It's just buyers disappear. So right
Right.
now it's kind of a buyer's strike, and that's what we're looking at. And the internals, that sell off, it looked more than a pullback. In other words, the breadth of the market was really bad. Um, like new lows are spiking on New York Stock Exchange and Nasdaq and so on. So if you even if you just forget about the macroeconomics and fundamentals and start looking at charts and internals, then it's looking like it'll probably continue after if we have a bounce, then it might be just a bounce, no more than that.
Yeah.
Well,
I was looking at a chart of the S&P earlier today, and you're looking at the next really support is about 4K. And if that breaks, we're going to be in trouble.
actually, it's a little higher. I think the major support, I think it's between 41 and 4,200.
Okay, I saw that
Yeah.
too. But yeah, yeah,
Yeah. And we're in 43 and a half, something like that, 4,350.
we're
Yeah.
right there.
Right. So if it's another 2 or 3%, it's still okay. If it's more than that, then I think it's not just a regular pullback correction. Then we are back and call it a bear market or call it something more serious than that.
Yeah,
Right now, there are a little bit more questions than answers, but it looks a little more bearish than I expected. So,
yeah. About that, because both of us were or I should say, moderately bullish. Probably 4 weeks ago,
right.
and it's interesting just how things have changed, how quickly things have changed. I think probably the big thing for me, and you actually mentioned this, that your lone concern 4 weeks ago was interest rates spiking.
Yes.
And I commented that's negative for stocks, and you agreed. And it seems to me that that concern is really starting to play out in a bearish scenario. There's a couple of things I would give the bulls, and I'm not trying to be wishy-washy. It's just confusing, if you would. And something anecdotal that I found interesting is Michael Burry, who won or bet all of that money on the housing crisis
Yeah.
15 years ago. He's an active trader and has his own fund. He just put on a $1.5 billion bet that was short the market.
Yeah. Well, he's one person, and
That's one person. And this is
yeah,
anecdotal too.
he tends to be bearish and more kind of sensationalist, I guess.
Yeah.
But he was right many times.
Yeah. So
Um,
yeah, you're right. It's one person, but it is somebody I listen to. So
yeah,
I'm not a screaming bear, but I would say that this is concerning at the least and confusing. You know,
that's right. We remember you and I kind of got bullish just maybe back in April, May, when we saw improvement in the economy, improvement in market internals. We were actually right. The market rallied more. Remember, Dow had like 13 up days in a row.
right.
Uh, the rally was broad. It looked good. Everything was fine. And as soon as August came, then instead of a pullback, it's all about China and interest rates. And if
Right.
interest rates stabilize and reverse, to the downside, in other words, the bond market start rallying, then we're fine. Then it's just a pullback and maybe a scary pullback, but it's okay. And maybe we're looking at some kind of buying opportunity over the next several days or so. But I have to see the interest rates first.
Yeah.
So if they continue to go up, and not just go up, but go up so fast, then the equity trader is getting scared. So, and it kind of makes me a little bit more bearish. I mean, so as I mentioned, right now there are more questions than answers, and we'll see what the BRICS will do. They have a meeting in a few days, and they're trying to get away from the dollar and do something with, other currencies and things like that. We'll see if the news come out of there. We'll see what the Fed says at Jackson Hole. I think it's also in a few days. They might either calm the market or the opposite. We'll see that. So everything depends on interest rates and news out of China. So there are more questions than answers. But right now I'm just observing it, and I don't like the internals again. I don't like the way the sell-off occurred.
Right.
It's a little worse than I thought.
What would make interest rates come down?
That's a very good question. Either the Fed starts talking dovish, say, "Hey, we're done raising. Things are okay. The economy is slowing down, but it's fine." Kind of a soft landing type of a talk. So people say, "Oh, okay, so that's fine. We can buy bonds now, buy more bonds." So
Yes. To lock in
yeah,
interest rates.
right. So interest rates would go down. That's the first thing. Maybe friendly economic reports. Friendly meaning not like we're growing like crazy. We're growing like crazy. That could be bad.
But we're
Good.
stable.
Yeah, but we're stable or slowing down a little bit. Things of that nature. That's what we would like to see, because we're going to wait for earnings till October, but next economic reports that'll come out September, they'll be very important. If the
Yeah.
economy is slowing down, at what pace is there, and God forbid if regional banks are repeating what happened in March, then this time the market will go down. So
Right. So let's talk about China. I was reading just the other day about they're starting to cut because of the slowdown.
yeah,
So it's one of those things that actually concerns me, because that typically should be bullish for stocks, but it's almost gotten to the point with China where bad news is bad news. You know what I'm saying?
yes,
So instead of a rally on China cutting, they're like, the news is China needs to cut. That's bad news because the economy's so bad.
yes, that's how the market interprets it right now. So if
Right.
the market is saying, "Oh, things are so bad in China that they have to cut," we're not used to it. We're used to China being okay and growing at huge rates, and the things are fine. And when we see that, the market is concerned. They're afraid that their banks could be in trouble, because we've been talking about it. And I talked to other people even a few years ago about how they built so many skyscrapers and empty. So
Mhm.
somebody financed, somebody's losing money on that. But back then it was just the talk. Right now it kind of comes to, maybe it's the reality. Maybe somebody's going to have to pay for it.
Right.
Well, and if they are in a deflationary spiral like Japan went through from 1992 and then several decades, then it could be trouble for our equity markets for at least short term. So as a kind of a shock to the system. So the China is not there anymore. China's growth is not there anymore.
Right. So it's interesting. Let's skim this out too, because there's all this in this world. There's a lot of negativity about the dollar. And I would say justifiably so. But a couple of things I think we need to consider as investors and traders. And number one, if we are entering a deflationary environment, that's very bullish for the dollar. Correct me if I'm wrong.
Right.
because people will want to go to, they will want out of risk assets, whether that's equities or less risky assets, which would be bonds. They just want out.
Yes.
So they want to go to cash, which would prop up the dollar. The second thing, and a friend of mine that I interviewed on this channel previously discussed, is where are people going to go? Because if China's slowing down, they're going to print, they print more than we do.
Oh, yeah.
So it's just it was hard for him. And now I'm becoming to be in that camp. It's hard for me to see where people are going to go.
I
So-
say that if equities are out of favor, whether it's a bear market or, or trading range and so on, I'd say the obvious are commodities. So not
Yeah.
necessarily all commodities, because if we're in a recession, then some of them will go price.
Like
Go.
industrial metals, you wouldn't want to be there.
Right, right, right. But I do think that commodities probably is a good thing. So people view them as steady asset class. So maybe let's park the money over there. Something that it will commodities is something you can touch. So
Yeah,
if
you're not dependent on a
on,
CEO or
yeah, you're not dependent on central banks and away from fiat currencies for a while.
right.
I think commodities would benefit. And actually, it's interesting to see that dollar has rallied quite a bit over the last several weeks. So it's a steady rally. And crude oil did fine. Crude oil
Yeah,
rallied also, which is, they don't have to be negatively correlated, but more often than not.
they are. And more often than not, yeah.
Right. But this time, I look at the chart over the last month or two, they both went up straight up the same.
Right. So we'll talk about crude in the next sections. That being said, as you do, I have investments in oil as
Right.
well as I watch oil very closely daily, if
Yeah.
you would. In the energy sector, specifically the oil sector, has held up, not only held up, it's had a nice rally.
Rally. Yeah.
Yeah. And what's interesting to me, I think that we're finally at the shift, and we hit it in June,
Mhm.
where the supply and demand equation is not only, it's not equal, which it's out of equilibrium the opposite way, if
Oh,
you
yeah.
would.
Right.
So that's, I think, finally becoming apparent to investors and traders.
Right. I was just going to say that we've been talking about it for months. And yeah, starting about 2, 3 months ago, people realized that and put the money there. So
Right.
it's interesting to know that the market sold off over the last 3 weeks, the S&P and other indexes. But look at the XLE and XOP and oil equity indexes. They're at the rally's high today. So, and they're pulling back just a touch. We were talking about XOP at 120, it went to 150, and today it's right there. It's 148. It's not in front of me, but it's no sell off whatsoever. That's the
Yeah,
only,
there's a lot of strength.
yeah,
Well,
the
it's
only
wrong.
sector that held up, and like doesn't matter what the market did. So didn't even pay attention to it.
Yeah.
That's a very good sign for not just for oil equities,
Yeah.
energy equities.
So in the next couple of weeks, what are you looking at for, for guidance over the next couple of weeks?
I would look at, we don't know what the macroeconomics will say. I have no idea what the Powell will say or anybody else. I would look at, everybody's expecting a bounce in the stock market. I mean, I'm expecting it too, simply because we're in the low sold. If the bounce occurs, judge the bounce. So is it broad? Is it convincing, or is it just, a few days? You can kind of read the tape. So if the balance is not convincing at all, then it means,
You got some pain.
yeah, something, yeah, downtrend will continue. So it's kind of right now, as I said, there are more questions than answers. I think they will be answered over the next week or two, or maybe even a few days. So let's watch the balance if it occurs and judge it. so to speak, and see if it's the beginning of, the beginning of a new uptrend, or it's just a dead cat bounce. So that's what I'll be looking at.
Yeah, I'll be looking at, yes, everything that you're looking at, and just mention two things. And that's really the thesis of this talk is China, seeing what news comes out of there. And
Right.
then watching like a hawk really about what the bonds are doing.
Yeah.
Um,
Everybody's looking at one chart right now, like
right. And
interest rates, like 10-year or TLT or whatever proxies. Yeah. Everybody's looking at it. And that's the most important thing.
yeah, right now myself, I am highly in energy and then in cash. I have some gold, some silver, both physical and equities.
Perfect.
But most of most of my money is in energy plays. They've done well. Again, I was taking the woodshed in the spring, but they're doing well. They're right where I should be now. I'll put some more money in those as we move forward, but I
Yeah.
am in a lot of cash. Um, and
Yeah. Basically the same. I'm energy primarily. I'm not in the gold right now, but I'm just observing it. But heavily in energy. I had a lot of options, call options, and bullish spreads. Some of them I closed because they're more like short term basis, and
yeah,
some expire. But as far as underlying securities, there are some individual ones, mostly indexes. I mean ETFs, and that's and trading the market short term. But as far
yeah,
as longer term investment, yeah, energy is my number one thing. Uh, I feel kind of secure, so to speak. I understand that we'll get pullbacks and all that, but I'm very comfortable being along.
yeah, me too. Okay, Dennis, well, thank you, and then let's do part two, oil or energy, right now.
Thanks, Andy. I appreciate it.
Yep.